My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends? I'm just trying to make you a little money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. After just a terrific day, where the Dow surged 511 points, S&P shot up 1.2%, NASDAQ pole vaulted 1.16%. Buy! What would allow us to have more of these sessions? Now, we know they can happen. Days like today are the reasons why we stick around this otherwise ugly market, correct? But we also know they've been few and far between, which is why everything in this market is a trade until the bears are finally slain and the bulls can trample unimpeded, which is not the case. After all, as I said last week, this market is deeply oversold. It remains that way even after today, so it can't continue to bounce. For most of you, though, that's not enough. You don't want to bounce. You aren't traders. I don't want you to be traders. So what needs to change so there's no bounce and there's just investing? As I told members of the CNBC Investing Club in my every single week think piece that I put out Sunday, we're stuck in a bearish box with occasional bullish breaks like today. Still lurking. There are unrelenting negative forces, some of which are obvious and some of which are much more opaque. So what can turn things around for more than a day or two? Well, let's go over them. First, we need many, many more buyers of U.S. government debt. For the longest time, the natural buyers of U.S. treasuries were from overseas, especially China. Just a few years ago, they owned more than $1 trillion in U.S. debt. That was rivaling Japan. Now China owns just over $800 billion, and you know what? They've been sellers, not buyers. These sales are part of the run-up in rates. If we want the bond market to turn around, they need to become buyers again. I don't see that happening. Japan isn't a buyer anymore either, just a holder. I can't see them increasing their stake. Our government needs to borrow massive sums of money to cover the deficit, and Washington has no plans to rein in spending anytime soon. I haven't seen one of you. That means we need more buyers to offset the impact of the treasuries that they're selling, or else interest rates will keep going higher, and it's been a historic run higher, and stocks will become ever less attractive versus bonds. That's why when we find out what issuance Treasury is going to give us when they publish the schedule Wednesday, there could be a major bond selling in anticipation of those sales. You see, we did get a fourth quarter borrowing projection from Treasury today, and that was less than expected, $776 billion, which was $76 billion lower than the previous projection. That's positive. But not if Treasury sells 10, 20, or 30-year paper to meet that hole in the budget. Two, if we want to get out of the bearish box, we need the Fed to stop selling its bonds alongside those from Treasury. And Treasury's not stopping. Maybe the Fed should. The Fed, it could stop, but they're unlikely to after something like last week's 4.9% GDP growth number. The Fed sells bonds as a kind of de facto tightening, so they likely won't stop until the economy cools down, and that sure hasn't happened yet. Three, we need growth, but without inflation. That means when we get our employment numbers, say on Friday, we need to see America still creating jobs, but just not nearly as fast, and with wages below what we've gotten used to. We would love deflation. We would settle for just a slowing in inflation. We got to get – look, if we don't get this stuff down, we're going to get another nasty sell-off. That's why I keep saying everything's a trade in this environment. No, I'm not saying this is one and done. I am saying that we are in a trading environment. Four, to get out of the box, companies need to give us better forecasts than we've been getting this earnings season. So many companies give us strong results, and you really think it's terrific, but then they just slash their outlooks, and it's so grim. On Semiconductor, that was the latest thing. What a fantastic company. With lots of chips headed to the auto industry. It had terrific numbers, but lousy guidance. And that's how a stock could fall $18 or 21%. Unforgivable in this market. I can't believe how downbeat these forecasts are. Last week's forecast that got cut, that was crushed, was Whirlpool. It just got annihilated. It was so horrible. Five, stocks need to stop getting slammed every time something goes wrong with another company in its sector, especially when there's a history of longer-term outperformance. We don't Danaher for the charitable trust because, you know why? Historically, for as long as I've been in the business, and I'm talking about the 80s, this is a well-run company, best franchise for diagnostics, and the equipment needed to invent new drugs. I mean, really, its history is incredible. But its history means nothing because right now, everything is meaningless except for how a company does in its sector. And if it's bad, then boom. Any disappointment sends its stock down, too. Until Danaher's stock stops being hurt by what I regard as negative pit action from its peers, this is an unsafe market. And that's just the analog for a lot of situations like this. Nobody gets the benefit of the doubt in a bear market, not even the companies that have earned it. Six, the Magnificent Seven done a remarkable job of masking the decline in the overall market. But this week, we get results from Apple, which I'd argue is the most difficult stock to game in this environment. Daily, we hear how Apple's a no-growth company with a stock that has no business being this high. How important is Apple? When it reports on Thursday night, it can determine what happens in tech until NVIDIA reports on November 21st. Wow, that's a long tail. But it's realistic. We don't just need a good quarter. We need a good quarter that they can get credit for. Tall order in a market where there seems to be so many analysts rooting against Apple and so many betting that it, too, will slash its forecast like ON Semi did. 7, we need to see all the price targets come down already. So many stocks have fallen after earnings, in part because their stocks have come down so much already that even if analysts have something good to say, they still need to cut their price targets, or else they'd look insane. This dynamic creates an incredibly downbeat setup because all you ever hear is like, hey, great quarter, cutting price target. Only a decline in price to a level where it doesn't matter can change that. But we clearly aren't at that level yet. 8th, we need to stop it with the wishful thinking about how the Fed's going to start cutting rates. I mean, there are so many people who don't want to buy stocks until the Fed starts cutting rates, but the Fed has told you that unless this economy puts together at least a half year's worth of soft numbers, it would be foolish to cut, and who can blame them? Look what would have happened if they cut, and then last week we got that 4.9% GDP growth. They'd be regarded rightly as idiots. 9th, we have to find some way to stop wage inflation. Now, these deals, for instance, between the UAW and the automakers, they are fantastic for workers, but terrible for shareholders. The auto stocks are horrendous, and they will stay horrendous because now they have to lose fortunes making electric vehicles while the rest of the business becomes less profitable anyway. In this environment, you have to assume that any company facing labor strife will end up with a lower price earnings multiple. The UAW leader, Shawn Fain, outsmarted everyone. He was incredibly effective at getting much more money for his people than anyone thought possible. It's terrific for his members, awful for anyone who owns the stocks. He deserves a lot of credit as a representative of his flock, even as he crushed a swath of stocks with his stratagems, including my charitable trust, which owns Ford. 10th, the 10th thing that needs to change is something that's beyond all our ken, which is the war in Gaza has to be contained to that area. It can't escalate into a regional conflict with Iran. Markets went down big on Friday, in part because it seemed possible we could wake up to a much wider war with the U.S. involved. Then if we don't get one over the weekend, well, then we have a reef rally just like we had today. Can these things happen? As usual, I want to say, of course. Do they all have to happen for us to break out of this bearish box? Unfortunately, I think we need most of them. Or we'll simply have endless sell-offs punctuated by these short covering rallies. And the small rallies can only be used to lighten up. Bottom line, look, I don't want to rule out these positives, especially when we're oversold. But I don't see the Chinese government buying bonds or the Fed stop selling them. And that backdrop in itself makes it much harder to own anything in this environment. Unfortunately, right now, the bears are in charge, with the bulls merely paying periodic visits to the New York Stock Exchange, like the visit they paid today, near the end of the month, and the one that they'll probably pay tomorrow when this miserable October finally comes to an end. Robert in New York. Robert.
Hey, Jim. How you doing?
I'm doing well. How are you? Oh, thank you.
Good. Thank you very much. You know, I read that NVIDIA augmented their large language model with 30 years of chip designs for their engineers. So this is going to give the senior chip designers about 60% of their time to developing new chips. Is this development with these chat boxes really going to catapult NVIDIA over all these other AI companies that are coming out with chips?
It's a great question. Now, they are well ahead of everybody else, and that's because Jensen Huang had a lot of foresight, but also because they kind of saw what could happen and took down a lot of chips. Now, that is not a reason to buy the stock of NVIDIA. The reason why you buy the stock of NVIDIA longer term is it's got the most thoughtful AI content. The reason why you might not want to buy it short term is because the market's awful. And I want you to make money when you buy something, not lose money. Let's go to Steve in Connecticut, please. Steve.
Hey, Jim. Thanks for taking my call.
You're quite welcome, Steve. Glad you called.
I'm a club member, and I appreciate all you all do for all of us out there.
Thank you very much.
But my question today is, instead of buying Wells Fargo, I bought Bank of America because I've been so impressed with the CEO and the performance. But I'm in the house of pain, being down 38%. But I don't need the money at least for 8 years.
Okay.
Jim, should I buy more or should I sell and roll into something else?
No. I think your analysis, by the way, is spot on about Brian Moynihan and what he's done at Bank of America. I think he's sensational. I don't think it matters right now. It's a bank stock. We bought Wells Fargo for the trust because Charlie Scharf's engineering an amazing turnaround and had a really great quarter. But no, I mean, it just doesn't matter. A bank stock, they're all trading the same. I think to lose hope right here at this level, though, would be a mistake. How about William in Indiana, please? William.
Hello, yes, William.
William, it's Jim.
Jim.
How can I help you? What's up?
Yes. Do you think Broadcom will close the deal? And do you think Broadcom's a millionaire maker?
I think Broadcom with symbol ABGO is definitely a buy either way. If they close the deal, then it has a higher price earnings multiple and go up. If they don't, then I think Hock Tan, the CEO, will buy as much stock as possible because he thinks the stock is very cheap. I will say this. I know that this deal was supposed to close, and they're claiming it's going to close very soon, but there's a paperwork issue. I need to see the deal close before I can tell people, look, this stock is going much higher. Close or walk away, not limbo. Unfortunately, even though sometimes we see some visits from the bulls, right now the bears are still very much in charge. It doesn't mean today, tomorrow can't go higher, but the bears are in charge. At least we know that this miserable October is soon coming to an end. And the stocks tend to go up on the final days of a really bad month like this one. On Mad Money tonight, VF Corp has a new CEO at the helm. It's Bracken Darrow, formerly head of Logitech. We've had him on so many times. So with a tech executive in control, is this what an apparel company like VF needs to turn itself around? Or is he a style executive? I would argue the latter. Let's hear more from the plan from the man himself. Then this earnings season, we're seeing one theme soar in the face of some volatility. I'm talking about the aerospace sector. I'm digging into the cohort and seeing if this bull market can continue. Yes, there are bull markets somewhere. And the last few years have been volatile for the travel sector. So what should you make of a cruise line stock like Carnival at these levels? I'm getting the latest on the story from the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.